Hey everybody, this is Paul. I haven't made a video in a while. I have been evaluating the status of my channel just to see if I wanted to keep up the weekly videos or do like a you know once a week or maybe a once a month kind of thing. I decided to do a once a month thing, just quick updates. Since the entire point of dividend investing is really you put the money in there and then you just don't do anything with it. It just kind of sits there in the same investment. So it's not like options or anything where it's, I can make more active videos. And I don't really have like a stock education channel. And then also coming up with narratives for the market is ridiculous because any narrative I come up with, somebody else can come up with a narrative. And that wasn't the whole point of this channel. It's just kind of to give just periodic updates on status of my investments. Um, so my plan was to come back on September 1st when you know, right after I'd made my last weekly video and start making videos then and kind of do like a monthly video kind of thing. But since I live in Louisiana, uh, yeah, I got directly affected by Hurricane Ida. So making an investment video at the same time I was trying to sell stock to free up money, this cash investment right here, so I can go live in a hotel for 14 days, that kind of stuff. Didn't even have power, so good times, good times. So I decided to make this video starting for October 1st. And I'm just going to do it on the 1st of every month, or I'm going to try to. Just as quick updates, kind of any investments I got going on, that kind of stuff. So, where we left off, I was right here in, say, August or so. I think that was when my last video was made. I was doing really good. Everything's going great. Everything's going wonderful. And then Hurricane Ida expenses, and also a very, very bad September for the market. So if I go into my portfolio, you'll see what I'm talking about right here. Go to performance and value. So we're going into, you know, into this little area right here, going into September. Everything's going great. I was up 16.46%, and then, yeah, it's like, yeah, it's September's been rough. There's all kinds of factors that go into that. Um, Market was expecting this huge $3 trillion stimulus bill, and everything was sounding like it was going to happen, and then it's just different things. But and then also Delta variant kind of looked like it was peaking, everything was great, and then yeah, you can kind of see what happened there. So my portfolio has effectively been tracking Dow Jones. Um, and then also you can just kind of see like everything went up, and then just kind of. Now I do expect everything to go up by the end of the year. Um, Once we get past some of these like government related things, and then also you throw in like things going on with the government. You got the Fed talking about taper and bond purchases. By the way, I'll show you what that actually affects. If you're kind of interested in what that actually affects, that actually affects municipal bonds, ETFs, which I actually have about I want to say maybe $2,000 still in. I closed out two of my very smaller ones that was less than $500, but municipal bond ETFs that actually affects that. The those actually go down because the Fed's actually been buying up municipal bonds, like just basically bonds and stuff like that. That's how they've been doing. So when they talk about taper, people start to kind of move their money around. And that's September was just basically rearranging money month, and then also you just had everything going on with China. So there's just so many things in September that you can go over and point the blame and just be like that was the thing that caused it. But it's just like one event after another after another. And all those guys who day trade and stuff like that, they were just kind of trading those headlines, and you get this market that is just like down 500 one day, up 500 the next day. So you just have tons and tons of things. Now, the funny thing about that whole period of time is really my dividend. The only reason my dividends went down right here, by the way, is because I had cashed out some, as I mentioned before. But as you can see, they're back up right around where they were before. Um, so, as you can see right there, currently combined 2,507. These two numbers right here. But basically just been having things like QYLD payout, that kind of stuff. I did pick up AT&T again, as it looks like it finally stabilized in that $27 range. Looks like it's going to be there for a while. I sold it when it was at 32, and I was kind of mad that they were going to reduce their dividend. They still haven't done it yet, which is kind of weird. So I'm wondering, I have to check on the news on that to see when that's going to go through. But it looks like the stock was trading at 32, and it looked like it was actually about to break out and finally go higher, but no. A lot of long-term investors got out of the stock, so it looks like it stabilized around 20, high 26, 27 area. So I jumped back into it and just going to collect the dividend until it starts, until maybe they announce a cut again. But I did pick up McDonald's. Um, that was one of the things I picked up, and then also I jumped back into Home Depot. Got a few in there, so I'm gonna try and buy maybe one share of this a month or so, and then also this one right here, FedEx. Uh, it's pretty obvious that FedEx and UPS have like a duopoly, not a monopoly, but a duopoly. They're basically competing with each other. FedEx talked about raising prices because they have some pricing power. Um, I do expect his dividend yield to go up at some point. And then also, I just wanted to add it in there as like a transport company. So as you can see, I literally own one share of it. I'll try and throw some in here every once in a while, but I mean, this is just one of those companies that's going to be around. I could check my portfolio 30 years from now, and we're still going to have FedEx driving down the street, or maybe in flying cars or something like that. But they're as the world economy opens up, as people keep working from home, kind of thing. It looks like FedEx is just it's kind of a good investment, even though it has a low dividend yield. Um, and then also I've mostly added one or two shares here or there to like different things that I've owned. Nothing really too new. Um, Mostly just basically move some money around. I did pull some money out of Verizon. That's where I got the little bit of the Home Depot money from and the McDonald's money from, just to balance out my portfolio. And then as it stands right now, like I said, estimated income per month is right here. And then here's that. I checked also, one good thing about FedEx is that it does have an October 1st payday, so it's one of these off months, as you can see. So it'll pay now, and then it'll pay again in 3 months, and then it'll pay again in 3 months. So it's one of these off month ones. I've been trying to boost up my December ones, which means things like Energy, which is the power company I own, J&J, McDonald's, that type of thing. That's another reason I go at McDonald's. But I'm going to try and keep boosting up my December one. I think Pfizer's in here too. This is a very easy one to buy. That's very, very stable right now. A little expensive, but you know, they just have so much money coming in from the coronavirus stuff. But today is kind of a weird day in the market. It was before the market, it was up 100 points on the Dow, and then it went down to like 7, and then you get this random whatever this is 1.38% spike, which is literally reversing the losses from yesterday. And if you go in here, you can kind of see what makes up that. So like specifically on the Dow, Merck, right? Because they're coming out with that new pill. You got Disney, IBM, just these weird things like Walmart's down because reasons. But it's really weird. You got like Zoom up, which is weird. Like you have this would be like the anti-COVID trade right here, like reopening trade. That's what this stuff is. And then this is the COVID trade. So, which you have Zoom mixed in with Marriott and Booking. Like it's so weird right now how the market's trading. It's like you just have basically people making bets on every part of the market, um, with different things that they think is going to happen. So, um, so it's one guy in my comment section. There's certain like smaller stocks. So he showed me a list of these right here, and there's one thing that's in common with all of these is that they're very cheap, and they have high dividend yields, which typically means to me is that their dividend is due for a cut, or they're just not going to grow their stock price. So you might get the dividend, but you won't get the capital gains that come along with it. Um, And capital gains is where if you're, you have to just have so much in a stock or to just get the real dividend out of it. But if you can see right here, for example, in General Dynamics, I buy it at 169. Not only am I collecting dividends on it, but I've also had a 17% increase in the stock price. NRG is a perfect example of this, 264. Pfizer is the easiest example of this, 305, that kind of thing. VTRS is down, but this is one of my long-term holdings. I expect this maybe in a few years to be an $18 stock, and I got it at 15, Regions, another good example. You can just kind of look through these. So the reason why I don't do that is because I do dividends, and that's the good part, but I also I try to get capital gains mixed in there too. So that's why I don't do the really cheap these things. And this is a good example right here, New York Mortgage Trust, for example. Like when I had originally had this, I think in 2018 when I started kind of investing, it was like a $7 stock. And then after coronavirus came through, pretty much every stock that this guy was kind of looking at was because they went, I think REML maybe was an example, or one of these was like a $15 stock, and now it's like $3. But his investment thesis is that not only would I be able to collect the dividend, after the coronavirus goes away, these might come back, like mortgage capital. Pretty much anything with mortgage, REIT kind of stuff, he has a really heavy focus on REITs. I tend to be more diversified and then to pick up more of the stocks that make up the SPY kind of thing. So like some of the bigger names, I have my investment theory or thesis is basically it's anything that I can see and you can keep track of, kind of like, there's a CVS in Louisiana. There's multiple CVSs. You can kind of see those. They're there. They're growing their footprint. Coke, for example, you always see Coke trucks everywhere. Home Depot, obviously. I made a large amount of trips to this place to fix my house after I had you can kind of see these places. Johnson Johnson, Pfizer, obviously, Pepsi. You can kind of look at these. Some of these, obviously, not must-aid, but, like Energy or like PPL, but those are utilities. But I prefer to kind of pick things that I can kind of see and then kind of keep track of, if people are buying it or not, that kind of stuff. But I, if you have like a less amount of money, like say if you only have like $5,000 to invest, I can see easily why somebody would just go with a lot of these. I didn't ask the guy how much he had of this, but if you go way back here, like way back here, for example, like 2016, 2017, when I think I did own a lot of those stocks, the little smaller ones, I only had like $8,000, that kind of thing, invested. So you can kind of see why you would buy some of those. And then as you start to get more money, saved up and invested and, put in there, you start to want to diversify because these are all sector specific, so they're all REITs. And they're very dependent on like bond rates. So if bonds go up, like the Fed's tapering, so that's automatically kind of like a rate increase. But if the bond rates go up, then these REITs might get hit because it's that's kind of how they work. So it's going to strain their ability to pay their dividend. But if you notice today, and this is a good example of it, so if you notice it's down by 4 basis points right now, and if you go right in here, up 2%, up 2%, up 1%, up almost 2%, that's what's going on. But if this reverses, which it is, because as soon as they start tapering, if they taper by a lot, these are going to go up much higher. Especially that once this starts going up, that's when those REITs start to really get hit. But so that's why I'm not. Once you start to try to diversify, that's when you have to start looking at the more expensive stocks. You just have to. You don't have a choice. And then you start going into the more traditional stocks that a lot of people go in. And then once you get into the kind of this range, like this $50,000 range, that's when you start buying the big things. Like the $222 stocks, that kind of thing, like the $243 stocks, the really big names, the Home Depots of the world. That's when you get into these. And I guess maybe when you get into the $100,000 range, just when you get into like maybe the $400 or $500 stocks. And then when you get higher than that, you start buying Amazon and don't care anymore. you know. But that's my only reason why I don't really touch these, is because yeah, the dividend might come in every month and it could be stable. But one of these I've been looking at, the dividend was cut from like, because the dividend was a percent of the stock price. So if the stock price went down just dramatically, well, all of a sudden you went from getting, like, let's say 10 years. So, like, for example, you're getting 20 cents here, and now all of a sudden you're getting 5 cents. And if it recovers, then good on you. You bought it cheap, and then the dividend will go back up to this 20-cent range because it's a percent of the stock price. But if you look at it, so just go out to max, for example. This is why everybody looks at this company, and this is always on the top like 10 thing. But if you look at it, it's been $6 since 2009 with a stable dividend, correct? For the most part until you hit a recession. But the problem is if you buy, I don't know, let's type in Home Depot, for example. You know, 2009 it was a $27 stock. Now it's a $325 stock. So yeah, you got a great dividend from the other company. But if you hadn't been investing in money from here to here, the same amount of money that you put into NYMT, if you put it into here, when it was at $33, all of a sudden it takes off $330 stock. It doesn't matter how much dividend NYMT is giving you. It's the capital gains alone is going to blow it out of the water. Just one share alone is going to blow that out of the water because it's like a 10-cent dividend per share. So that's why I try to capture. Once you get to a certain point, especially once you get into like say this 50,000 range saved up, you start looking at like, that's why everybody looks at O, because you get the dividend plus you also get some capital gains out of it because it does move up. Outside of these recessions, obviously, or these kind of COVID things, but like AbbVie, for example, that's why you start diversifying into these types of things, into these dividend ranges right here. And this is really where you see a lot of people diversify into, is these 4% ranges, 3% ranges, that type of thing. This is when you start doing energy company, like for example, like NRG, 3% dividend ranges. But if you look at just an example, 9%, you start diversifying away from these. 11% dividend ranges. These are all kind of typically, for a lot of investors, those are red flags. Now, his investment thesis is okay. It's perfectly fine. But the problem is if you retired and you think, okay, I'm going to collect off of IVR for the rest of my life, and you were making 56 cents a share and everything was going great, and now all of a sudden you're at 5 cents. Well, all of a sudden you're not retired anymore. So you're not like, in that FIRE movement. So this is why you have to be diversified, because these stocks, especially, you can't be diverse. You can't be so like focused on one sector, because like you're at 56 right here, and now you're down to 34, 36, 43, 5. And his investment thesis is that's going to go back up to this, and he bought it cheap. And that's fine. Or it could stay like that. It could do what New York Mortgage Trust did and stay like that for the next 10 years. And now you're holding a bunch of it while you're missing out on capital gains from just different things. So you kind of have to look at it. Like, for example, he probably bought New York Mortgage Trust this whole time. And in that period of time, like, so say if he bought New York Mortgage Trust when it bottomed out, for example, in March 1st, or actually let's say April 1st, here we go, until October 1st. Do you think he's made $12,000 in capital gains? This, by the way, this has already been taxed for 2020, but just to give an example, do you think that's how much he's made in dividends in that period of time? There were some stocks I was making $700 a day on They like Discover, for example, was going up, sell it, and then buy it. But that's why I was saying like, it's kind of hard to be so focused on one sector. It's hard to explain over a comment section as to why I don't do that, but that's why I don't do that type of stuff. But if you have like 5 grand invested, I could easily see why you would just drop a bunch into these types of stocks because they're cheap. They get you a foot in the door, and that's literally what they are. They're a foot in the door for the stock market, and you get used to getting dividends every day or every month, like or however often they pay. But there's nothing wrong with that, you know. And his investment thesis was is that the price is going to go back up after Corona. That's perfect. Um, but once I'm in this area right here, you know, I made $313 today off of these types of stocks. You know, that's you know, you would all have to own a lot of New York Mortgage Trust to get that kind of stuff. So it's just good to be diversified because if you're in one sector and then you try to retire off of that one sector and something happens to that sector, like coronavirus, a mortgage crisis, there's just been too many of these in my lifetime where it's just like the housing sector, which is not supposed to get hit, has been hit. You know, especially if you start getting bond rates going back up, the Fed starts tapering and starts raising rates again, those stocks are going to get hit even harder. So, like AT&T is like one of the better bets. But that's why people start diversifying. They start off small and then they move into like these types of names that you just know. But that's why I'm shifting to once a month videos because it's kind of boring. It's like, hey guys, this week I bought more AT&T. How about that market? You know, what's going on there? So, I don't know. Let me know what you think in the comment section. Like I said, the guy had a really good investment thesis. I kind of liked it. I'm buying them because they're cheap right now and thinks they're going to go back up. But, I'm kind of in a different spot probably from where he's at, that kind of thing. So, hope you like these once a month videos. I'll probably try to get the next one out on November 1st, and hopefully October is much better than September, and we can recover everything that happened in September there. So I'll let you know. Thank you so much.